Well, hello and welcome to today's webinar on my CPE. My name is Olive and I'm joining you from Houston, Texas. I hope you are all safe and healthy. So before we proceed, let's quickly ensure that your audio and video are working properly. So if you can see the screen and hear me loud and clear, kindly give me a thumbs up in the chat panel. Also, do let us know where you're joining us from, like your city, state, or any part of the world. You are most welcome to my CP webinar. All right, I see Mary has joined us today from California. Kathleen has joined us today. Louis from, all right, Dallas, Canada. I see a lot of attendees have joined us today from different parts of the country, and I welcome you all. Again, thank you so much for joining us today and supporting our One Credit to One Meal social initiative, under which we donate one meal to an unsolved. So thank you again for making your continuing education more meaningful. Please note that as per the regulations, you are required to remain logged into the session till the end, as well as answer all the polling questions. An evaluation form will be sent to you within the next 24 hours after the completion of this webinar if you have answered all the polling questions. In case of any audio difficulties, you can join in from your phone using the dial-in details available in the chat panel. And for any other technical difficulties during the webinar, please feel free to email us at support@my-cpe.com. As we all know, this is an interactive webinar, so feel free to put your questions in the Q&A panel and we will address them at the end or during the session. And if not, then rest assured that you will receive the answers via email within the next 24 to 48 hours. All right, everyone, let's welcome our presenter for today's webinar, Henry Montag. Henry is the managing partner of the TOLI Center East. He helps people understand their life insurance portfolio, whether they own life insurance policy individually or through a trust. He has years of experience in this field and he likes helping and making them familiar with insurance facts and benefits. So let's hear more from Henry about himself and the presentation. Henry,
Hi.
yeah. So thank you
Thank
again
you.
for being with us today. And without any further ado, the stage is all yours.
Okay, thank you, Olive. And thank you to the entire My CPE team for hosting the event. I'd also like to thank you, our audience. And as Olive mentioned, I've got enough information to go on for an hour, hour and a half, 2 hours. So I'm not short of information, but what I find that makes these more interesting is the audience participation. So if you have any questions, give a shout out and I'll go back and I'll try to, do a better job of explaining it. So, my objective is, at the TOLI Center, it's to basically just reintroduce a person to their life insurance portfolio and help them make sure that they're getting the most out of what they're already paying for it. But my objective today here is to basically share my, 35 some odd years, time in this business, in terms of just, sharing what it is that you should know about the subject of long-term care and how to protect yourself against having to pay for an unexpected, unreimbursed, significant cost. So, having said that, let's just move on to the first slide. Okay, so we're going to be talking about basically is matching and selecting a death benefit or a living benefit, because as you'll come to find out, a policy has both. We'll talk a little bit about the history of long-term care insurance, the industry. What does long-term care insurance cover? How does it work? How do you apply for it? How do you collect the claim? What are some of the current trends and the issues in the industry? And what are the various types of coverages that are available today? What is this thing called PPA, the Pension Protection Act, and this combo linked living benefit that it created? I bet you if I'd ask a question right now of how many have ever heard of it, I'd probably get less than half of you saying, yeah, I never even heard of the Pension Protection Act, but yet it affects everything that people do today so significantly, as we'll find out in a few moments. We'll talk about some of the corporate and the tax credits, and we'll also talk about the agent's role in the underwriting process of how you apply for this. So life insurance is an asset class, and as such, it provides for both the traditional death benefit that we all know of, and there are certain products term universal, guaranteed universal, non-guaranteed universal. And there are also some living benefits that most of you are absolutely not aware of. And we'll talk about those. And there are certain other types of policies that provide for the maximum living benefit: whole life, index universal, variable universal, private placement. This is not the right time to talk about the various products, although that is a very interesting subject. But for the time being today, we're only going to concentrate on the living benefits. So despite the fact that I've got the death benefits up here, providing family income, paying off debts, future state tax liabilities, the Secure Act, for those of you that are familiar with the future tax liabilities that the Secure Act today imposes on anybody with a inherited IRA. It also provides for educational funds. It provides for buy-sell agreements, hopefully funded buy-sell agreements for your client business partners, as well as, of course, providing legacy gifts to the next generation. But that's what we're not going to talk about. Instead, we're going to talk about merely the living benefits, paying for long-term care costs from the death benefit of a policy tax-free. That's significant. Paying for the long-term care costs from the death benefit of an insurance policy tax-free, as well as the tax-free exchanges of a life insurance and a long-term care insurance. So again, life insurance provides a living benefit. The most significant thing is the new combination hybrid link policies, where they pay for long-term care expenses directly from the death benefit tax-free. We'll also talk about the gains on an annuity. Okay, so for our first pop-up question, Olive, I turn it back over to you. Olive.
We have 10 more seconds to go before we end the poll. Please go ahead and submit your responses. All right, Henry, we have ended polling questions and the results are right on the screen.
Okay, thank you. So in the old days, those of you that selected B using the cash value, you would have been right. But today, what's significant is that today, a person can purchase a life insurance policy for $1 million today, and next month or next week or next year, unfortunately have a incident where they activate their long-term care rider, and they now have access to that $1 million death benefit, C, tax-free, to pay for long-term care. Okay, so let's move on. Can I get rid of that polling question on my screen? Olive, can I get rid of that polling question on my screen?
Yes. You can just move to your next slide. I have already ended the polling question.
Okay, so
Yes.
if I move to the next slide. Yeah, but I can't see my next slide because the polling question is in the way.
Okay, you can minimize that screen, right?
Okay, I can minimize this screen. Okay, that's why you're there, Olive. Thank you.
You're welcome.
Sure. All right, this is important. I'm going to take a quick second to read this because this is our discussion today. An unexpected illness resulting in an unreimbursed long-term medical expense can have catastrophic effects on the personal and the financial lives of your family, your client's family. Advance directives, buy-sell agreements, and other risk management arrangements that people make or don't make while they're healthy will determine the quality of their and their family's future lives. No ifs, ands, or buts about that. I've got 37 years experience to tell you that that's the truth. Those that plan ahead will avoid having their family deal with the financial and legal issues on top of the medical and the emotional issues that will already exist. And doing that avoids a family crisis. That's from the Advisor's Guide to Managing Risk. That was an ABA, an American Bar Association book that I co-authored approximately 3-4 years ago. Okay. Managing risk. If you and your client are the type of individuals to buy a homeowner's policy, even when their house is paid up, or buy collision on a car when there's no legal obligation to do so. If the car's paid up, nobody has an interest as to whether or not you get paid for that car or not. But if you or your client are inclined to do that, where the risk of a total loss in either the car or the home is less than 2 to 3, 2 to 4%, then they or you are most likely the type to want to protect against an unexpected, unreimbursed long-term care expense, with the odds of 75 to 80% of occurring by age 80, with a significantly higher after-tax dollar loss exposure. So just a quick word about long-term care today. It provides independence and privacy. It provides a care coordinator, which is someone who acts as a spouse, a daughter-in-law, somebody who basically takes the bull by the horn and takes the responsibility to really undertake a significant job of doing the things that somebody's got to do. I mean, if you're a mom and dad, or someone's in a hospital and they get discharged and you don't know whether they need to go into a rehab center or an assisted living facility or back to their house or what have you, somebody's got to make those arrangements. And then from that facility or that place on to another and back and forth, somebody's got to do all that. A care coordinator provides that peace of mind. The advanced planning also helps avoid a family crisis, as I just mentioned, and it allows an individual to care about a family member, not for them. From a corporate side, long-term care, group long-term care is the absolute fastest growing corporate personal group benefit that exists in the marketplace today. Because people our age, people, perhaps some of your guys' ages, are young enough to see their parents going through this. And they say, gee, I don't want to have my kids go through what I'm going through right now. So people want to do what they can to take care of themselves. Excuse me. It also allows employers can discriminate where they say all presidents, all vice presidents, all shareholders can have their long-term care premiums paid for, and it doesn't have to be done for the rank and file, which again, to you CPAs, that's an important issue. It does provide, again, talking about, important tax issues, it does provide significant tax benefits and credits, as we'll see in a few moments. And back in 2018, the Society of Actuaries said, all right, look, we know there's been a lot of problems in the industry, as I'll go over with you in a moment, but we now have enough stability for this Society of Actuaries to say that the premiums are now stable and that the reserves are sufficient to take care of the claims. From my own personal perspective, I started doing these presentations on the idea of paying for unreimbursed long-term care expenses back in 1986. The first one was to the New York State Bar Association. And as I say, since then, I've shared this information with literally tens of thousands of professionals. It's important, and I'm urging you to not just look at this as a CPE credit, as a CE credit, but to look at this as actually something that can be done to make your lives and your family's lives, or your clients' lives and their families' lives easier, better. So that's my personal perspective. There's a growing need for the service. The aging population of modern pharmacology is keeping people alive, and the age 80 is in fact the fastest growing segment of the population. But unfortunately, as we grow older, we don't necessarily, get to fix things, once and for all. And we do have what I call, what an attorney by the name of Vince Russo called a roulette wheel of illness. If you come down with the right illness, you win. If you come down with the wrong illness, you pay for it yourself. If you come down with some sort of a cardiology history or a cancer history, or just any type of dreaded, disease that slows you down, the Medicare will come in and Medicare will pay for it. But if you come down with the wrong illness, Parkinson's, or dementia, multiple sclerosis or anything that has a chronic, listing in front of it, well, then you're on your own. You've got to pay for that on your own. So the elder law population stepped in and began creating strategies. And what I can say to you is there's big risk out there. The costs are significant. We have people all across the country, so I'm not going to dare mention what the costs might be, but I will say that here in New York, we're approaching a significant amount of dollars, both for assisted living facilities to the tune of $7,000-8,000 a month, to nursing homes to the tune of, in some cases, $20,000 a month. Don't take 100% of the risk on your own. If there are 3-year or 5-year penalty periods, some people purchase the insurance for that 3 or 5-year penalty period or waiting period. Others say, gee, I don't want to just cover my waiting period. I want to have this fund available if I ever need it, or if my kids ever need it, to help take care of me. So they maintain it as ongoing coverage. If the cost is $400 a day, perhaps you might only buy a $200 a day coverage. Point being is that as Medicaid continues to raise its waiting period, more and more is falling on the patient/client. Hillary Clinton, when she was the first lady back in the 90s, tried solving this problem, but she found it was too expensive. The cost then, when $1 billion meant something, was $92 billion just that people spent on long-term care. Wasn't doable. New York State Partnership came in, they tried solving the problem. The Class Act tried solving the problem. The Pension Protection Act, which I'll talk about in a few moments, tried it. There's something brand new now called the Washington Project. There are many attempts at solving the problem, but the only way to really solve the problem is for the individual to take the bull by the horn, because unless you have Medicaid, not Medicare you get when you're 65, but unless you have qualify for Medicaid, where basically the state tells you what's going on, you have to pay for long-term care on your own. Medicare will pay for the first 100 days of long-term care costs. After that, you're on your own. Okay, so let's just talk about a long-term care insurance. Excuse me. Just talk about a long-term care insurance coverage. There's a daily benefit, anywhere from $100 to $500 a day. The duration can be anywhere from 3 years, 4 years, 5 years. Sorry. Years ago, they used to have lifetime durations. Insurance companies found out that was way too expensive for them, and they did away with it. There's a waiting period, and obviously, like deductible and car insurance, the longer you're willing to wait, the less expensive the premium. My suggestion is don't go shorter than 90 days and don't go beyond 90 days. 90 days is up until that amount. Medicare might pay. Beyond 90 days, that's too much of a risk for you to take. So a 90-day waiting period works. There are inflation options, 3%, 4%, 5%, simple interest, compound interest. Obviously, the more you want, the more it costs. How do you qualify to purchase? Well, very simply, you fill out an application, and then the insurance company writes to your doctors and gets the information from them. If you're over age 70, you're also going to get some sort of a cognitive test, just to make sure that you're not on the way to some form of an Alzheimer's. How do you collect benefits? Again, by the way, the insurance is only available up until age 75. How do you collect benefits? Again, your doctor decides that my patient can't do 2 of the 5 activities of daily living: eating, bathing, dressing, transferring, and toileting, or perhaps you can even do all 5 activities, but you have some sort of a cognitive impairment. Again, a senile dementia, Alzheimer's, where you just don't remember. And then too, you can get access to your benefits. The industry overview. Future outlook is strong for the industry because, as I say, people want the coverage. They just don't want to pay for it. There is the traditional plans, which I'll talk about in a moment, that are still available today. I call those the traditional or standalone plans. There are some good points and bad points. And one of the bad points is that the pricing is not guaranteed. There are also the new type, linked, hybrid, or combo plans. Again, some benefits and disadvantages, but one of the significant benefits is that the pricing is guaranteed. You can buy this on a group basis or an individual basis, and there are various discrimination rules, as I mentioned earlier, and there are also deductions available. And you can buy a plan that you have to provide medical bills for, and you can buy a plan that's called the reimbursement plan, or you can just buy the indemnity. And the indemnity just says if you're unable to do the two of the 5 activities of daily living, or if there's some sort of a cognitive impairment, then boom, you collect the maximum benefit on a daily basis, and you don't have to provide any bills. So here, take a look at what the costs might be, or the benefits might be for for a male, 62, and a female, 58. There's a discount for the fact that both husband and wife are applying. Rate classification can go anywhere from preferred, which is approximately a 25% discount to the standard rate. If you take 2 or less medications, you'll most likely get a preferred. If you take more than 2 medications, you'll go anywhere from a standard to perhaps uninsurable. Depends on how severe the medical history is. This particular example is a $200 a day benefit, or $6,000 a month, and it pays for the same $6,000 whether you're in your own home, or in an assisted living facility, or in a nursing home. Same $200 a day. The elimination period, as I suggested, is a 90-day. The benefit duration in all 3 settings, as I say, is 3 years. Inflation option that I chose is 3% compound. And as you know, that 3% compound is equivalent to 5% simple, meaning money would double at the end of exactly 20 years at 5% a year. Again, there are discounts involved, and the cost for the male 62 is approximately $2,900. The female 58 is approximately $3,700. Sorry to say that the costs for females are higher than the cost for males. Less the discounts, less the New York State tax credit, which is not a deduction, but a tax credit equivalent to 20%. In this case, knocking off the approximately $1,200 there, with a net premium of $5,368. And now again, that tax credit is only available up to a maximum AGA of $250,000. Insurance industry had some problems when this was new in the 80s. Underwriters, actuaries rather, had no clue as to what the pricing would be, and they just basically took a stab and just said, well, it should be about this. But every step they took, their utilization assumptions, their surrender assumptions, their yield assumptions of what interest rates were and what the insurance companies could earn was all wrong. Don't forget, back in the 80s, if you recall, interest rates were up in the high teens. And many of these companies, they're probably about 25, they all rushed out to see who could obtain the largest market share. Those were bragging rights back then. Today, that's unfortunately come back to haunt them significantly. All this led to significant premium increases. It led to significant bad press, people not trusting the insurance companies. Consumers were fearful to purchase it because they saw prices going up, and prices went up significantly, 30, 40, 50%. Sometimes it went up 30, 40, 50% twice within a few years. A very bad situation. So traditional long-term care, as we knew it, failed as a product. It was viewed as too expensive. The fact that it had a increasing premium trend was feared. It was an uncomfortable topic to discuss to begin with. And of course, everyone said, that won't happen to me. And if it does, I'll just self-insure. And again, people who were faced with the concept of buying this long-term care insurance said, wait a minute, if I don't use it, I'm going to lose it. That's not right. In many of those situations, I had to remind people, hey, it's just like if you have homeowners on your home, at the end of the year, you don't say, oh, shucks, my house didn't burn down. Or if you didn't have an accident where you totaled your car, you didn't say, oh, gee, I spent all that money, but I didn't get anything for it. Same thing with long-term care. No, if you don't use it, you will lose it, but that's the cost of protection. And many people just felt, hey, it's easier to go to an elder law attorney. I'll just artificially impoverish myself and I'll apply for Medicaid. Easier said than done, but many people decided to go ahead and do that. Over the years, Medicaid, of course, has made it much harder for individuals to qualify. And as a result of all that, very few people bought as traditional long-term care insurance. But the insurance industry is not and never was a stupid industry. Along comes the Pension Protection Act. Along comes a collaborative effort between the government and insurance companies, which was designed to provide consumers the guarantees that they needed against rate increases. It also created additional private ownership of long-term care by individuals. It also benefited the insurance company's profitability because more people had that coverage because the government made it easier and the insurance companies made it easier to own that coverage. Therefore, it also reduced the Medicaid rolls because fewer people would deal with Medicaid if they could buy insurance that they thought that they were getting something out of. So it was a win-win-win situation for everyone all around. And for the first time, it allowed combination or the hybrid of the combo of linked life insurance. It allowed paying for long-term care expenses from the death benefit of an insurance policy income tax-free, which is why there were so many incorrect answers to that first polling question, because no one is used to getting a living benefit from the death benefit of an insurance policy while they're alive. But lo and behold, that's exactly what the Pension Protection Act did. It allows tax-free transfers from the insurance company directly to pay for long-term care bills. So it was a solution to their rising premiums. It eased consumer concerns to future rate hikes. It reduced the insurer's risk. It reduced the federal and state Medicare bankrolls expenditures, and it increased private ownership. Like I say, it only worked. If only you could take care of that. If I don't use it, I'll lose it. But the insurance companies thought of that too, because when you combine life insurance with long-term care, if you don't use the benefit during your lifetime to pay for long-term care costs, then your beneficiaries receive the full death benefit, also 100% income tax-free. It really worked. It really. So again, beating a dead horse just for a quick second, for the first time, insurance company purchases a combo linked life insurance policy, and it pays for long-term care costs from the death benefit of a combination linked plan, 100% income tax-free. Okay, here's what it looks like. Somebody buys $1 million life insurance policy, week one, month one, year one. They have an option for a 2% payout for the next 50 months of $20,000 a month, or if they wanted 4% payout a month for 25 months, they could get $40,000 a month. And for those individuals needing care in a major metropolitan area where the costs range in the vicinity of 25 to 30,000 plus a month, that 25 month can pay for an awful lot of bills. And again, all distributions are 100% income tax-free. Majority of new policies today contain the option of either having a chronic care rider where there's no upfront costs, or a long-term care rider where there are upfront costs. And again, I can't go into this now. It's a little bit beyond the scope of this conversation, but just make sure that you're comparing apples to apples. And keep in mind, if no funds are withdrawn to pay for the long-term care claim, then 100% of the death benefit goes to the beneficiaries, 100% income tax-free. Olive, pop-up question number 2, please.
Please submit your responses while the question is on the screen for next 10 seconds. All right, Henry, we have ended poll and we have the results.
Okay.
Yeah.
Okay, got it. Okay. And again, proceeds from death benefit used to pay for long-term care costs are income taxable is false. There are no, as the government's really trying to incentivize people, and anything they can do from a income taxable point of view to make it easier to buy, they've done. So again, there are no income taxes to be used to pay for long-term care costs from the death benefit of your combination life insurance policy. Okay, again, you've got to compare apples to apples. And let me just delve into this. Yeah, just let me delve into this just for a quick moment. Let's look at cost for male age 60. Traditional cost for $500,000 of life insurance is $5,000. The traditional cost for $500,000 of long-term care insurance is $3,000 for a total of $8,000. Whereas if they buy the combo plan for that same $500,000, the cost is only $7,000. A scrupulous person might say, buy the $7,000, it's $1,000 cheaper. A smart person might say, well, wait a second. If I pay the $8,000, I'm getting the life insurance, plus I'm getting the long-term care it provides, and it pays for both. Remember, under the combo plan, if they use the $500,000 during their lifetime for long-term care, it's deducted from what the beneficiary receives. If they never use it, the beneficiary receives $500,000, and that costs $7,000, but they're only getting one or the other. On the traditional way, they're paying $1,000 more, but they're getting twice as much. So again, choices have to be made, and comparisons have to be made, obviously with someone knowledgeable and someone independent to be able to shop the marketplace. So again, there's nothing inherently right or wrong about a traditional combination. It just depends on the individual's usage. You know, when we use a traditional or combo plan, under the traditional, as far as I'm concerned, when there's no need for an inheritance, it's just a single couple, children or well-to-do, or gone or whatever, or never been there, and they just want to take care of themselves. Certainly paying less money for traditional would make sense. When the emphasis is on the insured, when tax credits are important, that 20% New York State tax credit is only available on the traditional long-term care, not on the combo plans, or at least not yet. When cost is a factor, because the traditional does cost less. However, when might one use a combo plan? When there's a need for an inheritance, when the emphasis is on the beneficiaries and providing for the long-term care is just in case, when guarantees are important and you don't want to pay more, because the ability of buying insurance can be done on a guaranteed basis. To this very day, you cannot buy traditional long-term care insurance on a guaranteed basis. The individual insurance company retains that right. What they do have to do is they do have to go to the state insurance department and request a rate increase. And in the past, they've gone to the state insurance department, and the insurance department has in some fashion compromised, but there's still been rate increases. And sometimes when there's a medical situation, when medical history might be an issue, then too, it's easier to get a combo plan than it is a traditional if you're looking for the long-term care. There are also benefits for the annuities. I just want to make sure. Okay, we're in good shape. There are also benefits for annuities. And I'm just going to say that distributions made from an annuity to pay long-term care premiums are doable, and distributions can be made tax-free to pay for long-term care costs. So you can pay for long-term care costs themselves, and you can also pay for long-term care premiums. Benefits of the Pension Protection Act. Looks a little bit like this. On the left side, under the old rules, you could transfer life to life. You could transfer an annuity to an annuity. You could even transfer life to an annuity. Under today's rules, you can transfer an annuity to a long-term care contract tax-free. a life insurance policy to a long-term care contract tax-free. And that's significant because in the past, if you had gains in the cash value of your life insurance policy and you wanted to use those cash values, you would have to pay taxes on the gains. Today, you can transfer that cash value to a long-term care insurance policy and do that 100% income tax-free. So that's pretty significant. It's also a good idea for some people who may no longer need life insurance, but they want to use those funds or use the value of that life insurance policy to be used to pay for straight long-term care insurance. You can do that today. And my next 1 or 2 slides, I'll give you an example of how that can be done. Get to that in a second. What is an SPDA? It's a single premium deferred annuity. What are the benefits of an SPDA? It allows tax deferred accumulation at guaranteed interest rates, regardless of what silliness is going on in the stock market today. Guaranteed interest rate. Today, that's very meaningful at 3-4%. Guaranteed settlement options for the beneficiaries. You make certain that from the death benefit of that insurance policies, that your wishes and your settlement options can be spelled out for the beneficiaries. Distributions of gains from that single premium deferred annuity are 100% taxable. Okay, distributions of gains, unlike everything that I've been talking about before, where they're not taxable or income tax free, the distributions of gains from an annuity of any type are 100% taxable. And it's a good vehicle to accumulate, but not to distribute. Okay. Annuities are good places to accumulate, tax deferred, but they're not the best places to distribute from because they are taxable. And here's an example just based on a $50,000 annuity on the left side prior to the Pension Protection Act. They started out with $50,000. They had a gain of $50,000. The tax on that $50,000 is, I'm assuming, $20,000. Available is $80,000. But after the Pension Protection Act, that same basis of $50,000 with a gain of $50,000 is now not taxable, and $100,000 is now available to be transferred to a long-term care insurance policy, tax-free, which benefits the insured today. And these are significant benefits. And how does that work? For male 68, start off with a $100,000 premium. You get a $159,000 death benefit just in case you die. But what you're buying is almost a $500,000 benefit for any type of long-term care. A SPIA is a single premium immediate annuity. It provides a guaranteed immediate income. A single lump sum given to an insurance company in exchange for a choice of guaranteed predetermined tax-favored payouts. Tax-favored, partially tax-free. A SPIA, when used on its own, provides an immediate, guaranteed, partially tax-free. It's an exclusionary ratio where you might only have to pay taxes on 60 or 70 or 80%. So that's why I say it's partially tax-free, and it provides benefit for the rest of the person's life. But if you have a SPIA, your or a client's SPIA, and by the way, there are billions of dollars of SPIAs and single premium deferred annuities in your client's portfolio that probably haven't seen light of day since they were purchased. But if you have a SPIA, pay a long-term care insurance premium directly, that partially tax-free becomes 100% tax-free. Might not sound like a lot, but when you have premiums that people pay on an ongoing yearly basis, that difference becomes significant. The government is successfully trying to incentivize people to buy long-term care insurance instead of going on Medicaid, and they're succeeding. Various major stories in Wall Street Journal discussing these strategies. But let me divert for a moment and just talk about some of the tax advantages. If you or your client are involved or own a C corporation, you are in long-term care haven, because you can discriminate. You can do this only for officers. Again, the sightings are all in front of you. You can take it as a qualified long-term care income tax deduction to the company, and the individual still receives the benefits income tax free. Not so good if you're an S corporation. There are various credits, which are standard credits for anyone, whether they're an S corp or not. Pass-through entities, yeah, good. Self-employed person, could deduct 100% of the premium paid for the individual as well as the individual's spouse. And then they're, subject, of course, to the 78% of the adjusted gross income, which is the standard deduction. But pass-through entities, can take advantage of this. So what's an agent or a broker's role? To explain everything that I just threw at you over the last 40 minutes, to do it in a way where it makes sense, where you get to ask questions, where you can see all of the available options and all of the available strategies in a quiet, interactive way, where the agent can assist the client to decide on what's important to them, to being able to specifically take the client's data and match the client's objectives with the various products that are available, with the various strategies that are available, to be able to explain the underwriting process. I glanced over that. I'm going to come back to that in just a moment because it's so important. But what a person completes on their application, standard thing is for somebody just to, well, I don't want to disparage anyone else, but the underwriting process is extremely important, and the information that you provide to the insurance company is extremely important. And you've only got one shot to make a good first impression, and that agent's letter, is very, very important in terms of introducing the client to the insurance company. And then, of course, it's the agent's job to manage, when I say agent, I'm speaking of an agent or a broker, to manage the entire administrative process and deliver the policy. And just a quick word on the difference between an agent and a broker. An agent is somebody who might work for one of the major companies, one of the major mutual companies, Penn Mutual. I don't want to begin naming the companies, but you know the names. Somebody pays for that agent's office. Somebody pays for that agent's health insurance, for that agent's retirement benefits, for that agent's secretary, for that agent's costs. And the insurance companies that do that, the career agent shops that do that, must charge a higher cost for their insurance, because somebody has to pay for that expense of the agent, and it's not going to be the insurance company, it's of course the client. A broker, on the other hand, is an individual who is independent, who pays for their own costs and does not have any allegiance to any insurance company. And the way that I operate my practice is based on the individual's health history and based on their medications is which company I go to. And it's always a matter of obtaining the best cost and the best way to spend the client's money. And that's what any individual who acts on your behalf should do. How would an agent handle rate increases? Many times a customer gets a bill from the insurance company with a 30%, 40%, 50% increase, and is told, this is what you've now got to pay unless you decide to decrease your dollar coverage, your duration of coverage, your inflation option. Again, and a broker who gets involved with his clients or her clients, might harness that individual from just cutting their premium, but, spiting their nose to do that. You'll never get back the coverage that you're giving up. If you can pay the additional couple $100 premium, again, if the individual can't pay for it, that's one thing. But in most cases, clients that you're working with, if they can't pay for it, don't worry about losing the additional $200, $300. You'll never get back what you've lost. If possible, pay the increase. In later years, yeah, you might want to drop the inflation option, as it is 50% of the cost of the premium. I usually tell clients above age 80 to drop the inflation and save half the cost, or consider dropping, because there's still some people who have lifetime coverages. And I do tell those people to drop from a lifetime coverage down to a 5-year, because usually utilization is less than a 5-year period.
Hey, I'm so sorry, Henry, to interrupt you, but
Yeah,
this is a reminder that we have 5 minutes to go before you want to open the floor for the attendees for Q&A.
perfect. Thank you. So, current objectives, they avoid premium rate increases, they maintain the existing coverage. You can decide on a traditional or combination plan. From the insurer's point of view, they get increased premiums at a reasonable rate. They offer to decrease coverage. I'm telling you as your advisors, and for yourself as a consumer, try not to take the offers, but the insurance companies, many people take the offers, and it works, because people are usually not in touch with their agents or their brokers for that matter. And the insurance companies are looking to return to market profitability. From a regulated point of view, it avoids them having to deal with bankrupt insurance companies, and it gives them some manner of controlling the increase in premiums to a reasonable level. Summary of benefits: proceeds of LTC are now 100% tax-free. Life insurance can be converted to long-term care insurance tax-free. A SPIA can be used to pay long-term care premiums tax-free. 100% of the untaxed gains, a lot of tax benefits here. 100% of the untaxed gains of an annuity can pay for any long-term care expenses. A hybrid plan might be a better way. Well, a hybrid plan is a better way to self-insure. So for those individuals who said, well, if anything happens to me, I'll just self-insure. Now think about it. If a couple, husband, wife, spouse, whatever, needs to pay $100,000, what do they have to take out of their CD or of their investments to get net $100,000? Depending on the tax bracket, it's going to be more than $100,000. Might it not be better off to pay a premium that provides on an ongoing basis, on a tax-free basis? Yeah, I think so. It's no longer a matter of using it or losing it. If you don't use it, you can get it back. Your beneficiaries can get it back. And if you choose to, which I haven't even mentioned here, but keep in mind that an individual has the ability to sell a life insurance policy while they're alive. It's legal. It's called a life settlement. As a matter of fact, I believe one of my next lectures on my CPE is going to be about the specific of a life settlement. All sorts of options, and the majority of your clients and yourselves as well probably are not aware of it. Harris Poll did polling on individuals aged 70 and over that gave up their policies back to the insurance companies. They surrendered their cash value. 90% said had they known that they could have sold their policy instead of surrendering it back to the insurance company, they would have at least considered it. I can tell you that if the cash value of any policy is X as a life settlement, if the individual is over age 70, you're probably going to get twice the amount as a life settlement by selling your policy rather than as surrendering the cash value back to the insurance company. Remember, the insurance company is not on your side. They are on their side. Their obligation is not to the insurer. Their obligation is to their shareholders, stockholders, stakeholders. Keep that in mind. Don't wait for the insurance company to protect you. Last pop-up question.
15 seconds to go before we end the polling question. All right, Henry, we can move ahead.
Okay, so again, I know some of you might have thought that I was trying to trick you, but no, the correct answer is all of the above. You could read it. Life insurance could be used to pay for long-term care costs from the death benefit, tax-free. Death benefit distributions are 100% income tax-free when used to pay long-term care costs. Most new policies today offer some form of a long-term care benefit. And D, of course, is not of course, but D is the correct answer. So a lot of this information is in one chapter of the this book that I co-authored a couple of years ago. That was the ABA's title, The Life Insurance Policy Crisis. My title they used as a subtitle, but it's the Advisors and Trustees Guide to Managing Risk. A lot of you have clients that assign their children to act as trustees. Unfortunately, their children sometimes know less than they do about what, not sometimes, most times know less than the insured does about a life insurance policy or the trust that they've been asked to be the what I call the amateur trustee of. These people need help, and you, as their CPAs, as their accountants, are the only call or the only chance that they've got to be made aware that, hey, that life insurance policy that you've got lying in your bottom left-hand drawer for the last 10, 15 or 20 years needs to come out, needs to be taken a look at, because perhaps it's going to expire before you do. Perhaps it could be enhanced. Certainly they could enhance their risk management coverage today based on what was available 10, 15, 20 plus years ago. You're the only shot they've got to have somebody ask them to do that. If you'd like some additional information, I suggest you download the handouts. There are a couple of articles that I've written over the years, good articles, if I say so myself, that really, basically just explain a lot of what we're speaking of today. So take a look at that. Again, I'm a resource, meaning feel free to get in touch with me over the phone, over email. I'm not on Facebook, so that doesn't work. But if you have any questions, I'm happy to act as a resource and literally provide you with some of the information, background to some of the information that I just touched on today. So with that said, let me just open it up to any questions that might have come in on the chat. Otherwise, I've got a couple of questions on my own. I'm just curious. There are approximately 75, 78 people on this call. Just curious, how many of you, Olive, are you able to do this? If I ask how many of you know someone that is requiring currently some form of long-term care, be it at home or in a facility or in an assisted living facility, if I could just ask people to, just put a check mark in the chat.
Yeah, sure. Yeah, sure.
Can you do that?
So please go ahead, everyone, and put your responses in the chat panel so that Henry can see the responses.
I'm just curious, how many people know somebody that's requiring some form of long-term care?
All right, we have received 3 responses so far. All right.
Just something to think about. Just something to think about. Unless, yeah, I see.
Yeah.
Yeah, I see. So also, I think everyone's had a chance just to put a yay or just put a check mark in there. And I appreciate that, because this is information that I benefit from just as far as just polling information, in general. I'm just also curious, before today's session, how many of you knew that life insurance can be used to pay for long-term care costs tax-free from the death benefit? This one is really important. I'd really appreciate your taking the time to click the box and just let me know whether yes, you've heard about it, or no, you haven't.
Majority of them say they did not know this.
Yeah. Okay. If nothing else, if you've just been made aware of the fact that life insurance today can be used to pay for long-term care costs tax-free from the death benefit, you've gotten your money's worth. And that's, I don't know if I should have said you've gotten your money's worth, because usually you get what you pay for, and there was no cost involved because of the generosity of my CPE to have more people become aware of the subject of long-term care, which I'm telling you, not only you, but your clients are just not aware. To this very day, long-term care has been around for 30 years. There still are not people who are aware that this is something that really makes sense. And just like in the past, not everybody had a Medicare supplement. Today, you don't ask, do you have a Medicare supplement? Instead, you ask, what Medicare supplement do you have? In a short while, people are not going to be asking, do you have long-term care insurance? Instead, they're going to be asking, what type of long-term care insurance do you have? Or what company do you have it with? Major factors. So I'm just curious, do we have, just a general consensus that most people were aware, most people were not aware? And in between all this, again, I welcome the 50 minutes is well over. We're approaching an hour. I'm not going to keep anybody beyond what they want to stay. So again, are there any questions that I touched on that need any sort of clarification?
All right, Henry, we have not received any questions so far in the Q&A.
Okay, so again, I'm available to answer any questions, and fortunately or unfortunately, this is what usually happens after we hang up. I'll get a couple of email questions from individuals, and I welcome that. Use me as a resource. And again, I'd like to thank you for joining us, and I'd like to thank my CPE for hosting the platform. And I look forward to seeing you at some point in the future on my next presentation. Olive, thank you. And I'm going to sign off unless anybody has anything else to say. And we're just about on time with the hour.
Thank you, Henry. Always happy to help. So thank you very much, Henry, for such an informative and insightful session. And you made it truly interesting by sharing those examples. It's always a pleasure to have you with us on our platform. One
Thank
more
you.
important thing, everyone. To obtain your credit certificates, you will receive an evaluation form within the next 24 hours after the completion of this webinar if you have answered all the polling questions. If you need to view the recording of this webinar, or if you have any further questions, please feel free to email us at support@my-cpa.com. Well, that being said, thank you so much, everyone, for being such a wonderful audience, and keep coming back. Take care of yourself and your loved ones. Stay safe, stay healthy. Thank you.
Thank
You
you,
so much.
Olive.
Yeah.
Thank you. Thank you.
Bye-bye.
Bye-bye.